access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, CSW, nor its affiliates, nor any of the respective offices. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the SEC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Okay, fantastic. All right, let's start having a meeting. How are the markets looking? We've had an exciting day already. It's Fed Day. We've got the Fed coming up in 1 hour. So we've got to be on our toes. So this is just a statement, so it's going to be very few words, and we'll go through the process here. Let's look at more charts. All right, so we got a little bit of a recovery. The Dow's bouncing. I chickened out early on the Russell shorts. They came down a little further than I thought. Oil was a nice $500 drop twice this morning. So that's good. Gasoline was a huge drop. From 158.5, we called the top over here. We went down to 156. It's $840 a contract on that one. Here's Apple, which is driving the market higher. All right, Apple's up 6.4%. Apple is 15% of the NASDAQ. Therefore, 15% of 6.4% is like 1%. And that means that 1% of the NASDAQ's half a point gain is due to Apple. Okay? So that means that the NASDAQ outside of Apple is falling. So it's up a half a point, but it's falling on that. Apple's a major Dow component. Apple added $7, $8. A Dow component is worth something like 8 to 8.5 points, but call it 8. And so say 8 times 8 is 64. So 64 positive points are added to the Dow from Apple, and it's only up 25. That means the Dow is down 40, if not for Apple. Okay, and of course the S&P, same story. Apple's a major component of the S&P. I would say maybe 3% of the S&P would be the effect of Apple. So you're talking about, still, 0.2% of the S&P. So actually, it's funny if you do that. If you subtract 1 from here, he's down a half. If you subtract here, he's down a quarter point, and the Dow's down a quarter point. So, again, this is why chart people drive me nuts. It's like, because TA people never take things like this into account. The reality is that the markets are down about half a point. That's the reality. Apple is single-handedly holding the markets up today. So there's nothing bullish about what's going on right now. Apple continues to go higher. It's testing 130. And so we're just looking for when it stops. And once Apple stops going up, there's nothing supporting all the selling that's going on underneath. They got to be real careful about that stuff. As far as current plays, the only thing I'm really into right now is we have 2 long NGs at the, I'm sorry, what the hell is that? Oh, no, I thought that was open. I was going to say, I thought I closed that. NG, okay. So natural gas, and it's funny because this morning CNBC was really bashing natural gas hard, like you're trying to get people out of this trade. So I have 2 long again. We had a nice run yesterday. We had a nice run into the morning, and we gave up as it started failing 320. But I got back in as soon as it hit whatever the hell this is. As soon as it hit 315. So actually the average is here is 312.8. So I had 2 at 312.8, but anyway, 315 is a good line to play on natural gas, and look, you get a run up here that's $500 per contract. So be happy with that. What looks playable now in the futures? Let's say nothing really. Because look, we don't know what the Fed's going to do. If gasoline is breaking below 155. Gasoline is probably good for more of a dip than where it is now. Usually we like to go long on gasoline on Wednesday, but I think we're going to have a deeper sell-off before it turns around, maybe down to this line, 1523. I'm sorry, 153. Basically, it's a 153 line over here. But again, the big thing is if Apple tops out, then the push it's giving the market now will go away. And even worse, if Apple starts pulling back to and it shouldn't be over 130. So if Apple starts pulling back, that becomes then a huge drag on the market. So very scary stuff. The Fed not expected to raise rates. They're expected to stay steady. They're expected to maintain their generally dovish language, economic circumstances, blah, 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 blah. But it's hard to say that nothing has gotten worse since the last meeting. There's really technically no reason they shouldn't be raising rates. So they're going to have to kind of find an excuse for why they're not raising rates in order to not do it. So we will see what happens. And the dollar, let's look at the dollar's under 100. Now, if the Fed doesn't lower rates, the dollar will probably rise, putting a little bit more pressure on oil and gas. We want to go long on gas into the weekend if we can, but I really don't want to go long on gas unless we're on this line. Like 1525, 153, the very most. I don't feel good about going long on gas at 155. Not at all. All right, so that's it for that part of it. And we've got, let's see, it's 109. So we've got basically an hour until the bed, so we'll see what happens. Hello to all your mothers. What? All right. I'll tell you said hi. RB long entry now. Wait for low. No, we're waiting for low on the RB. Comments on NG. Would appreciate hearing thoughts on going long on the futures as a strategy. What are my thoughts on going long on the futures as a strategy? Look, it's like any long-term bet. Okay, didn't we have this discussion earlier? I thought we did. Here's the key. Where's my fin visit? Okay, here we go. Take coffee, for example. Coffee. All right. So you look at a weekly chart. And I started liking coffee in June. And it went up a bit, then it went way down. It's actually lower now than June. So what am I better off at? I bought it in June. I wanted it for long term, but I think it's going to go up. I think it's going to go back to 250 in a couple of years. I definitely think we're going to see 200. So 151, you're talking about a 50-point move up at $100 a point. That's a $5,000 move on the contract, okay? So, would I invest in coffee long term? Well, the problem is, though, even if you take the long contract, they're still only going out about a year, the ones that are tradable. And you're going to watch it go up and down and up and down and up and down. I would rather take the money and run. Like I prefer to play it where I take this money. We cashed out up here. It had a nice run. If my plan is that we get to 250 in 2 years, then if we get to 225 in 3 months or 6 months, that was my plan. So why should I ride out the pullback? Why hold it? Not to mention, though, that when you do a close-up, knowing how big these moves are, so here we are in June, right? We came in at a really good time. We put a nice run up at the beginning. Then it went back down. then it went way back up, then it went back down, and now it went back up. So this is $2,000, then it goes down, then $2,000, then it goes down, and $3,000, then it goes down, and then $2,000. So if I'm now, obviously you can't call everyone perfectly, but generally we're pretty good at this stuff. So by going in and out, you've got, what did I say? You have 3 plus 2 is 5, plus 3 is 8, plus 2 more is 7. So here, there's $7,000 worth of upside. And if you just sat on the same contract, you're only at $2,000. You know, we're not idiots. We know when something got toppy. We know when something gets low. We know when something gets toppy. We know when something gets low. We've been in and out of this multiple times, and I don't think we've really taken, we took a loss. Actually, here we got in too early, and we rode this down, but then it came back, and we were fine. This was the worst play we made, was trying to get bullish on this line. Because it failed that line. It went down really hard and fast. I decided to stick with it. We had that little bit. Didn't get even, and then it dove like crazy, and that was a bad loss about a month or so ago. But then we stuck with it. The key was, though, the fact. Now, see, that's the point. Because I'm long-term bullish, and nothing shook my long-term premise, I decided to stick with it, and thank God, because I got all my money back. But you got to be able to afford to do it. With these losses, $10,000, $20,000 when they're down. So if you can afford to lose $20,000 and wait patiently without having a heart attack, then fine. Then play long term. But if that's going to stress you out, or if you look at this and say, I'm down 20,000, as long as I don't go down 25,000, I'll be okay. And then you go down 25, say, okay, 30,000, I lose my house. If you're in that kind of situation, you shouldn't be. There's no way you should be playing long term, and there's no way you should be playing without tight stops, because it will happen. This is only 1 year. In the course of owning something for multiple years, it will happen to you. The chances are just as good, even if you're right. Okay, here we go. Let's look at gold. Gold. Okay, gold. Well, okay. I mean, look, here's gold. I was pounding the table at 10.50 on gold. Anybody who's been here knows I was every day, gold, buy gold, 10.50, ridiculous, blah, blah, blah. Banging the table on it, right? So I was right. Generally, I was right. I'm still right about 10.50. Okay, here's 1100. But the thing is, it doesn't make it go up in a straight line. I think ultimately we're going to hit 1,500 on gold. It makes it very attractive at 12. But it doesn't mean we aren't going to go back to 10.50. In fact, the situation has changed, because when I was saying 10.50 was the lowest, ABX was pulling gold out of the ground for about $1,000. Now ABX has dropped their cost. Their low-end cost for gold is under $800. So they can actually, and that's the world's largest gold miner, they can afford to sell gold for $800. So I'm less sure that 10.50 would be a floor now than I was, because my logic of saying 10.50 at the time was that's how much it cost to take it out of the ground. The simple premise, if gold goes below 10.50 and it costs 10.50 to pull it out of the ground, it isn't worth pulling out of the ground. That's going to shut production down, and especially as ABX was the lowest cost producer. Now, what happened since then, and the same thing is happening with oil. So now let's take a look at oil. And we're talking Brent. At $40, I was banging the table on oil. Why? Because $40 is what it costs to make oil. You go below 40 and people shut down. And it costs different amounts everywhere, but I'm just saying on the average, $40, oil can be produced generally profitably. Anything below $40, people, it's not a question of voluntarily shutting down. It's not an OPEC thing. $40 is the point at which every barrel you sell loses money. At some point, you have to stop selling oil. You will go bankrupt. Now, what happened since then and this is a problem for oil bulls, what happened since then is the people who did go bust or were forced to sell off their assets in a bad market were forced to sell their assets for a lower cost. But that's an opportunity for other people who buy the assets, and they're buying the oil, they're buying the reserves for like $2 a barrel, something like that. You know, when ABX buys gold in the ground, they're buying it for $200. They don't buy mines that cost more than $200 an ounce. So they bought somebody's entire operation based on their proven reserves of gold for $200 an ounce. That's how ABX works. And then because ABX's internal math is saying that we can pull it out of the ground at about $600 average cost. You know, like, and they're like, obviously, they you know, depending on the degree of difficulty and how accessible. But ABX knows what it costs them to pull gold out. They're better at pulling gold out than most people. That gives them an advantage when they go to negotiate a mine, because they have a lower cost because they know what they're doing, they have better equipment, they're more efficient, they have better techniques, they have better people. That's how you win. You know, if you're a builder and you can build a house for $50,000 less than somebody else and the house is just as good, you'll win more contracts, right? You will sell more houses. Even at the same price, you'll make more money internally. That's what ABX is like. They're like a really efficient machine for getting gold out of the ground. So what they look for is other people's mines that they can buy cheaply, and they just run the math and say, yeah, we'll buy the mine. That's why I love ABX. It's a constant thing. Every time when they use up a mine, they buy another mine. They've got plenty of money. They sold off. Oh, and by the way, to get their cost down, they didn't do anything magical. They didn't come up with any innovation in gold. ABX, to get their cost down, sold off their less productive mines, lowered the average cost. They said any mine that costs us more than like $1,000 to pull gold out of the ground, we're dumping the mine. And you can do that because there are plenty of people who like to speculate and buy. They love to buy a mine from ABX, and they think that they're going to come up with some way to get it out of the ground, or they do bad math or whatever. Again, the fact that ABX has better people than you do. So they know that they can't make the money. And also, by the way, other people are speculating on gold, so they say, oh, I can buy this mine, it only cost me $1,000 an ounce for the gold, and I think gold's going to be $1,500, so we're going to have great margins. That's speculating too. You're just speculating by buying the entire mine. But ABX sold off all their lesser performing assets. That's why they had such a significant drop in margin. But they still got 100 million ounces of gold that they can pull out of the ground for $800. All right, so oil's similar. Oil companies do this all the time. They sell off their unproductive wells. So when they need cash, when they start burning cash, because even somebody who's got oil that costs them $50 a barrel, right? They still got to make their payroll and so on and so forth, and cash flow and pay off debts. So even though they're only collecting $40 a barrel for the oil that comes out of the ground, they still need the $40. So they'll sell at a loss because that loss is against abstract things like the sunk equipment costs and their overall operation and the money they invested 10 years ago to buy the oil. All that is the money they're losing. So in other words, your house, right? You have a mortgage on your house. It's $3,000 a month. It's $100 a day. Okay. So to break even now, besides your mortgage, you have taxes and you have utilities and blah blah blah. So let's say it's $6,000 a month to run your house. So it costs you $200 a day to be in your house. But for whatever reason, you need to rent out your house to get some cash. Okay? So even if you get $150 a day, which is a loss, because your mortgage is X and this is X and this is X, you're still better off getting the $4,500 to rent it for the month because you need the cash. So you get $4,500 cash. It's going to put you more behind on all the other stuff, and you're not paying down your mortgage and blah, and you're not paying your taxes or putting it off or whatever, but you're still collecting the money. And it's the same logic when you go to sell an asset cheaper than what you bought it for, when you sell a mine for half of what you paid for the mine, because you have to get rid of it. It's not productive. It's hurting you. All right? You sell it to somebody who can make use of it. You're doing the same with your house, right? You're renting your house to somebody who, for $150, says, great, good deal for $150. You're losing money. They're getting a good deal. So what happens with oil is more and more people are sitting on these oil patches that they bought for very cheap prices. That's lowering their net cost of production. So $40 may not be the floor anymore. When push comes to shove, we may drop very fast because a lot of people have oil they can produce very, very cheaply now. It's a little bit of a different situation than we had before. What the hell started that conversation? I lost track. Anyway, all right. Oh, futures. Well, okay. So the gist of it is, though, that these things change, right? You know, over time, the situation changes, the floors change, the prices change, so on and so forth. I'm generally more comfortable just making new bets. But when I have macro conviction of something, like in coffee's case, global warming, so when I have a long-term conviction that something is hurting the crops overall, and we had this conversation last month, because in coffee especially, you know, we had a lot of chagrin over coffee because it went down nasty and kept getting worse. It's funny because it doesn't look like much here, right? But when you're in it, well, not hourly, when you're in it here, it doesn't seem like a small thing, does it? It's still above where we came in. We came in over here. So it's still above where we came in, but only barely, and a lot of people came in later. But we talked about this all the way down, and I kept saying, I said, look, you have abundant crop reports coming in. That's what happened here, too. We have some abundant crop reports coming in. A lot of different countries had some great growing seasons, and they've got a lot of coffee coming in from like South America, from the southern hemisphere where it's summer right now. So there's been a good growing season, a lot of coffee. There's a good supply, but that supply, there's a lot of demand too. That's going to start eating into the supply and any disruption along the way. It's like when you invest in natural gas. In natural gas, when you invest in natural gas, in the fall, you have a hurricane season. And it doesn't happen all the time. Oh, all right, anyway. So, look at this. See, here's hurricanes. I don't know if that was a hurricane. Hurricanes for sure. Don't think that was a hurricane. But, you know, every once in a while when you're doing natural gas, you get a hurricane. You luck out. I mean, obviously, people who deal with Katrina and Rita or whatever are lucking out. But when a hurricane knocks off natural gas production, it spikes the prices. So another nice reason to be a long-term natural gas player is this happens eventually. All right? You can't count on it. It could go years without happening. It has gone a few years without happening now. You can't count on it, but it's lovely. Also, with natural gas, the reason we're long-term long is because underlying everything is that we're exporting more and more natural gas. Now, problem with natural gas, though, at the moment, and this is what CNBC was pushing today, is they're saying, well, if we go to a trade war with Mexico, Mexico is our number one a receiver of natural gas. We send them a ton of natural gas. So, therefore, we'll have a huge glut here because who's going to replace Mexico as a huge natural gas buyer? Now, that's a lot of ifs in the logic because, first of all, if we have a trade war, looks like we might, but that doesn't mean that nobody's going to buy anything. It just means things will change prices and come out at different costs. You don't stop trading because you have a trade war. In other words, if you produce food and the electric company produces electricity and they need food and you need electricity, you can call it whatever you want, but you're still going to trade food for electricity. You can put taxes on and tariffs on and put quotas on, but the bottom line is you still have more food than you need. They still have more electricity than they need. You're going to trade. So, a lot of this is like hand-wringing bullshit with the trade. And again, frankly, trade wars are idiotic. Trade barriers are idiotic. And they only hurt the people it only hurts the consumers, really, in the end. But in Trump's case, it's another way for the government to impose a tax on the poor without calling it a tax. Just another word for tax. Tariff is a tax. They're taxing the goods and services you want to buy. And the tax disproportionately affects poor people. That's all it is, a stealth tax. They make you pay 20% more for your avocados, and rich people get a tax break. That's how it works. There's all these sneaky ways they're taxing people and passing costs down to the bottom 90% of the people, so the top 10% can get tax breaks, and they can call it revenue neutral. Not to mention building an idiotic wall. All right. Anyway. All right. Casey's been my champ CEO, change machine, blah, blah, blah. Okay, great. What to make retail like blah, 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 time to enter some plays. You got to be careful with retail. Retail, look, I like Macy's because Macy's is doing what you need to do in this environment. They're cutting 10% of their stores. 10% of the sales go online, cut 10% of the stores. It's not complicated. And what's Macy's doing? They're cutting the 10% top underperforming stores. They're setting themselves up for success in the future. But that's painful. You have to pay for layoffs. You have to pay off leases. You have to close stores down. You have to try to sell off your assets, blah, 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 blah. It's a lot of crap that ends up being charges to their balance sheets while they're making the cutback. Anybody who runs a business knows, closing an operation doesn't make you money right away. Doesn't actually save you the money. In fact, it sometimes costs you more money the year you're shutting something down than you're going to save. Not that you're going to save long term, but then you're saving as far as that thing. So you have to be careful. KSS, forget it. They're a serial disaster. Kohl's. Everything they do seems to go wrong. As you can see, there was a lot of optimism, but then the fact of it failed. They've been failing for ages. Everything is like, we're going to do this, yay, no. We're going to try this, no, that didn't work. We're going to try this, that didn't work. We're going to try this, nope, that didn't work either. Not good. It's like Sears. Now, Sears is different. To me, Sears, whoa. I think Sears is basically being just stripped of its assets by Eddie Lambert, who runs the company. I think he's just stripping it into his other enterprises. So he's making money, but everybody who actually owns Sears stock is just getting completely screwed. And he can do that. He's transferring, he's making these crappy real estate deals, crappy for Sears. He's spinning off their best real estate assets into this ESL, into ESL Holdings or whatever it's called. And they're picking up all the properties, and they're picking up the rights and the brands and so on and so forth, and then they sell those for top dollar. The Sears holders get nothing, and frankly, look, and from a pure point of view, Sears is bankrupt. So why put money or why leave assets and whatever? He's just doing what everybody wishes they could do, is declare bankruptcy and strip out all your and take all your assets and give it to somebody else before we declare bankruptcy. He's taking everything of value in Sears and putting it somewhere else where the bankruptcy court can't touch it. So that's a special story right there. Anyway, Macy's I like. Target I like too. Target, they're kind of like a Costco Junior. They're not bulky stuff like Costco, but they do have like a warehousey sort of thing, and people like going there, and it's not priced stupidly low like Walmart. I think they found a really good sweet spot where they're kind of like they keep a nice clean store. They don't have a lot of staff, but the place is gorgeous. It's like compared to Walmart, the place is gorgeous. It's just a nicely put together operation. They very smartly have Starbucks and Pizza Huts and things in their stores. So, it's a whole thing for kids to go there. And the prices are good, and it's just generally a good thing. So I think they've got their crap together. Not that they're getting rewarded for it. I mean, Target, where's Target looking? But I think that if you want to bet on somebody, Target's a good bet. Yeah, see the same thing. The whole retail sector is down and down and down. But I think this is a good spot to buy Target. I don't think I would pick up Sears or whoever the hell we're talking about, Kohl's down here. And Macy's also. Macy's. We have Target and we have Macy's. So we are picking up the retailers we think will work. Macy's, I just think, is kind of hysteria. So you don't use futures as a hedge against portfolios. That's why there are 4 portfolios. What? Okay. Hang on. Okay. Yes, I use futures as a hedge against my portfolios, but not everybody can play the futures, so we never count them officially in our portfolios. That's all. We don't track futures trades. We don't play them in the portfolios because it wouldn't be right when a lot of people can't play. I mean, some people can't even play options, but that's obviously that'd be silly because that's the whole point, is to teach people how to play options. But I'm not going to track futures. It's just extra cash that we pick up on the side as far as from a tracking thing. But no, I think futures hedges are great. But if you're talking about using it as a long-term hedge, again, no, because I'd rather I'd rather pick it up for quick money. If the market is selling off quickly and you're not prepared for it, or even yesterday, like if you were short on the market and Apple had the good earnings, you could immediately buy the NASDAQ futures. You know the NASDAQ's going to go up with the overall market. So you can use it that way, but I don't. Again, long term, it's not really an ideal hedge. And I much prefer to have a hedge that's offset with a short put that's not going to actually lose any money if the market goes up. A futures, if you're wrong, you're wrong. If it goes up, you're going to lose a lot of money. So you have to be really, really amazingly good at futures trading to do something like that. What do we do with a short 110 call? I'm ready to cash out my Apple long. My target is 130, but you're not being rewarded for the play, and you certainly don't want to leave yourself net short on the spread. And we do have the short 110 calls, which are protection. Now, we only have a 1/3 sale or 1/4 sale, depending on which portfolio you're talking about. Let's see. What the hell? Oh, a data error. I'm like, how could this be 72%? That makes no sense. Something went wrong with their system. Oh, wow, look at that. Everything's 0. Well, it's nice to know if everything went to 0, we're still up 72%. That's because we have cash. Oh, what a great example. Look, every single thing went to 0. We've got a complete 100% loss on everything. And we still are up 72%. Why? Because we have cash. If the market collapsed tomorrow, if it was 9/11 tomorrow, we're still up 72%. That's freaking good to know, right? I was not going to be good examples here for anything, though. What was your question now? I forgot. That was funny. I was like, how the hell could that have happened? Oh, the Apple short call. That's right. We can still look at the play. So Apple, blah, blah, blah. What was I going to say? Oh, yeah. Okay. So here we have 30 longs in the spread and 10 short calls. All right. Now, the 10 short calls, I imagine, are $20 each at least. We sold them for $6, so we're down 14, which means we're down $14,000 here. I don't know. Now, here's where the problem is. I have no idea what these numbers are, but we also have the puts, and the puts will expire worthless. So we sold those for $8. So technically, we sold the puts and calls. Forget the fact that we have more puts and calls. We sold the puts and calls for $14, $15. So we're only down $5 on the puts and calls together. And we're going to collect $90,000 here. So we're down $5,000 here, and we're going to collect $90,000. We're up net $85,000 if this plays out. And again, 5 extra puts means we're actually up $90,000. That's the whole $90,000. That's a brilliant freaking play. But at the moment, you don't have $30,000. You don't have $30 in this spread. Your net in the spread is nowhere near 30. We're not worried about Apple going lower. The point of this trade is to wait and let the thing mature. What we are doing, though, is right now these are locking in the price. Now, we may decide, excuse me, we may decide to do something tricky, like, all right, we have 10 January 110 calls. I would not want to take a big risk, but okay, so the January 110 calls are $23, and we've got the 100s, which are $34, and the 130s, which are 16. So our net is like $18 on that spread. We're going to make $12 more by leaving it alone. And the short puts, I don't remember which ones they were, but the short puts, if they're 90 puts or something, or 95 puts, they're $5. And they're going to make $5 for us. So our problem is these guys at $20. But they're 110, we're at 130. Now, if I want to be fancier, what I can do is take my $20 and I'll roll it to, I don't like those. I want to get at least $10. All right, these. No. Don't like that either. See, I don't like the prices. All right. See, I don't like the roll, so I wouldn't do it. But in theory, let's say that we roll to the April 130. So we're going to pay, we're going to cost us $15 to make the roll. But we roll to the June, in this case, 130 call. So now it's $5 a premium. If that expires worthless, then we picked up $5, and we're still negative 15, or not counting the money that we got paid for the short call. But we're still negative 15. But if we do that 3 more times, we wipe out the loss. So we'll probably do something. But we have 2 full years between now and 2016. So 2016 between now and 2019. So something like that when it's appropriate. But first of all, we want to see where Apple stops going down. Second of all, at the moment, it's acting as protection to our gains, negating the need to sell. And I can't dismantle the spread. The 100 calls they're $35. But if I dismantle the spread, I'm leaving myself short the 130. Don't want to do that. Because I don't think that's a good idea. I think Apple's going to be at 150 by then. All right. Now, actually, if you look at it, though, these are already 16. If I was right about the 150, they're only going to gain $4 more. So it might make sense to take it off the table. But frankly, I'll take it off the table when these are like $45, and then I can do something else. But I'm not inclined to mess around with something like that. I just leave it alone and let it mature. Unless it's way, way over the price, then I can do something about it. But I don't want to just take it off for the sake of it. Please go into detail on your thoughts on Apple. I like Apple. Those are my thoughts. I like Apple. I think they're a good long-term stock. I just wrote a whole article about it. Lash doesn't want to lose his boat. That's a good idea. Although, actually, losing your boat could be the best financial decision you make. I've never met anybody who wasn't wasting a huge amount of money on a boat. Are you still super bullish on Best Buy? In fact, I think the reason I have money today is because I never bought a boat. There we go. Are you still super bullish on Best Buy? Not Best Buy, Bed Bath & Beyond. Am I super bullish? I don't think I was ever super bullish on Bed Bath & Beyond. What do we even have on those guys? Long term. Oh, wow, the long term. The long term holds up really well if everything goes to zero. Wow. 131, that's hardly even a lot. Oh, that's because we have so little. Is it going to tell us the right amount? Yeah, we have so little here compared to what we have in cash. We have $1 million in cash. We only have $200,000 in play. So, yeah, we can take it. All right. Wow, this is a great stress test. Never thought of that. Set everything to zero and see what happens. So where are we? What was the question? We were looking for something. Damn, I'm very easily distracted today. What's going on? Shop, Best Buy, or Bed Bath & Beyond. Yeah, I thought so. We only have short puts. This is not super bullish. We sold some $40 puts. The stock is at God knows what. The stock's at 40. We sold the $40 puts just recently in December. This is not super bullish. This is a toe in the water kind of play. Yeah, and don't forget, our obligation here is to buy 500 shares at 40, it's $20,000. Not nothing, but this is this is now our $1.5 million portfolio or something. What is it? No, 1.2. $1.2 million portfolio. Wait. I don't know what it is because the thing is not right. I think whatever it is. I don't even know anymore. So let's say it's a $1.2 million portfolio. So, it's not a big amount. $20,000 is just an entry for us. And we're looking at picking up 5 contracts. But all we did is the normal thing we do. We sold 5 contracts. We collected $22.50. And it's just about collecting our normal monthly thing. We saw that Bed Bath & Beyond was low. And we said, hey, okay, that's a good price for Bed Bath & Beyond. I don't mind owning it for net 35 or net 35.50. So when was that on 12/21? So here when it crashed, that's exactly here. So when this happened, we said that's a good price and we like it. So do I still like it? Yes, I still like it. I still think it's a good trade. I think that's a good floor for the price. But again, I don't know how much damage Donald Trump is going to do to the U.S. consumer. It's hard to say. It could be severe. And that means that none of these things are going to be a good price. We think you damn well better have hedges and you better not be too attached to these positions. Because this whole ball of wax can start unraveling. What do I think of Shop? It seems like huge online retail and taking a lot of internet businesses from the physical store. Well, look, Shopify to me is not, look, it had a great year, doubled, almost, well, let's say doubled. It was 20 to 51. So it's 150% gain in a year. It IPO'd at 30, now it's at 50. So it's getting close to double its IPO price. I'm not sure. I don't believe they make any money. Let's find out. Okay, so we'll take a look at Shop. I don't think they make any money. No, they lose money. Okay, so the sales are up. So we're $200 million here. Now we'll look at the quarterly. And only, what? No, the quarterly reporting doesn't work. Okay. I don't know where they're at the moment. I haven't looked at them lately, so I'd have to get back to you on it. But they don't make any money. And all right, well, the bottom line, okay, yeah, let's do this more. Okay, here's the analyst. They're not going to make any money. But even if you think they're going to make money, $205 million in sales, and they're asking $4.5 billion for the company. So they're asking 20 times sales. Now, Amazon doesn't make any money either, or they started making some money, but they didn't used to make money either. They get a great valuation. But 20 times sales is a lot. In fact, Amazon, I don't think Amazon is at 20 times sales. Let's find that out. No, they're not. See, this is where my problem is in the Shop. So Amazon has $100 billion in sales, Oh, actually, no, there are a lot. I've done $100 billion in sales. No, and their market cap is $400 billion. So Amazon is 4 times sales. And I think Amazon's ridiculous. It's 200 times earnings at their current earnings. So Amazon, after being the most successful company on the planet for online retail, is selling at a completely ridiculous 4 times sales and 200 times profits, yet you want to pay 20 times sales for Shopify, which is a flea on the butt of the flea on Amazon. So, no. All right, that's how I would arrive. So if you asked me that question in chat, I would have done all that and come back to you and say, no, I don't think so. All right, so yeah, it's like, yeah, of course, online retailing, just because someone isn't online. Okay, you know what? That logic, it's kind of like saying, forget online, take away the word online, and say, oh, well, I went to the UPS store, they seem to be doing good, and a lot of these stores are doing good, and so that means I should buy that means the Christmas shop must be a good investment because it's also a retail store. It's got nothing to do with each other. Each entity is different, and believe me, you cannot do a better job than Amazon does as far as efficiency and automating and so on and so forth, and their websites and their design and their little ways that they get the customer to buy more stuff. They're brilliant. Like you buy something and they put stuff below and say you probably also want to buy this, and then they have your list for you and they tell you what you like and they remember the stuff you wanted. They're doing everything you can possibly do to get people to buy in a perfect system. You still don't make any money. Amazon makes no money on online sales. Amazon makes their money as a cloud service company. 150% of Amazon's profits are from cloud services. So in other words, all their profits from cloud services, and cloud services has to take half of it, 1/3 of its profits, and put it into the losses that the retail sector makes. And it's a symbiotic thing, though, because cloud services makes a lot of money because, now, it's a weird way to look at it, but cloud services makes a lot of money because they don't have any costs because Amazon needs all the cloud space. So Amazon sells excess cloud capacity through cloud services to other companies. And then they layered it on with like technical expertise and things like that they do. But the bottom line is Amazon wouldn't have a profitable cloud service if it wasn't for the retail. But the retail runs at a loss, allowing cloud services to be very profitable. But that doesn't make either one, well, it makes cloud services good. It doesn't make either one as good of a business as people think. But that's why Amazon is such a dangerous stock, because people think it's a great retailer because the cloud services mask the fact that they're losing money, and people think they're great cloud services because the retail operations mask the expenses that the cloud service company would otherwise have in setting up all those servers. So, that being said, and then everybody's pouring money into the space because it looks like it could do something. But it's not going to be like that. When everybody's an online retailer, in fact, I said this to Chinese people last week. I was on that TV show, and they said, what's going on with the U.S. retail? And I said, look, 100 years ago, you went to the general store in your town, and they weren't 10 stores. There was a general store. If you wanted a wedding dress, you go to the general store. If you wanted your teeth, if you wanted a toothpaste, you go to the general store. If you want a horseshoe, you go to the general store. Maybe a blacksmith. Maybe there's a blacksmith for that. But there weren't that many specialty places. Basically, everything you got was at the general store. I don't know why they called it the general store if there weren't other stores. But like a supermarket today is a consolidation of all the different kinds of markets, and they're still set up, a lot of them, like marketplaces. Like you have the fish shop and the butcher and the baker. It's all in there. But that's what, in the old days, it used to be just a bunch of different shops. It wouldn't be a super market, right? A general store was the store that had all your general needs. Anyway, so you used to have no choice in town. There would be a store. You would buy your stuff at the store. People say, where are you going? I'm going to the store. They didn't say, which one? You're like, that's it. I'm going to the store. And frankly, people would go 20, 30 miles to go to the store because there was only one in the county. Now, then Sears comes along with a catalog. And they start mailing these catalogs to people and saying, hey, all you have to do is contact us with these newfangled telephones or write us a letter and and say, I want this and I want that. And we will process your order and ship it to you. And it will come in less than a few months. And people thought that was incredible. So that was the online innovation of its time. And they knocked out the general stores. But what happened is that they sort of they took a large share of the market, but that large share of the market wasn't all the market. They didn't wipe out the concept of retailing. What happened is the general store broke up into more and more specialty stores that had a better selection and more stuff than the Sears catalog had. So, in other words, the Sears catalog did not physically have room to have 500 hammers and all this crap that a hardware store would have. The Sears catalog didn't have 25 kinds of dresses to look at. They had 8 dresses, and you looked at those. So the Sears got beat, and not beat like, it did get beat because by 1980 there were no more Sears catalogs. They had an 80-year run of great growth. They built the Sears Tower, biggest building in the world at the time, in the 70s. That was the peak of Sears' power, basically. But then right after that, the catalog business died. It just couldn't be sustained. Why? Other people came up with catalogs and stuff. The other stores had their own catalogs. Macy's had a catalog. Other stores had catalogs. And so then you start, and remember for a while, if you're old enough, you used to get your mailbox stuffed with catalogs. And that was how but even so, even at that, a very small amount of business, 10%, 15% of all retail business was bought through catalogs. The rest was bought through stores. That's all that's happening now. Is we're now back in that same model, and there's going to be a saturation point in retail for online. The only thing is you haven't hit it yet. So, of course, you have explosive growth because you haven't hit the saturation point yet. But once they hit that saturation point, which we're pretty close to, I think 15%, 20% tops, you're going to hit the saturation point, and then all of a sudden, that's the end of it. Then people say, okay, this is the stuff I buy online. Everything else we go to stores for. They keep trying all these different things, but the bottom line is people like to see things and touch things and look at things. And, you can say, oh, virtual reality will do this and that, and we'll have all these techniques and update all this stuff. I still think, though, that people are social animals, and there's a certain experience to shopping that's going to be hard to get everybody to get rid of. So I think we're going to hit a certain point, and then that'll be that for online. And it's not going to grow forever. It's not going to take over all of retail. It's not a $3 trillion opportunity, which is, I think, all of retail is about $3 trillion. It's not a $3 trillion opportunity. It's a $600 billion, 20% of retail opportunity, and Amazon's already got $100 billion of it. So maybe they'll grow to $200 billion and have a third of all the retail of the online business. But if it turns out that 10% is the saturation point, then we're already basically there. And you're seeing it now. You see all the retailers are moving into online. It's not that hard. See, now that's the thing also. Amazon benefits from the fact that they were first and they've got all this stuff set up, but it doesn't take that much to copy the experience and make a better experience, especially for individual stores who concentrate on their things. And they'll be able to provide a better service. Also, by the way, Amazon's making a huge mistake. Amazon should buy Sears, because what Amazon needs is they need places people can go to return stuff. More than anything else, they need customer service and return. So they need a place where people can go when they get something they don't like from Amazon, they bring it back. Not having that makes people very reluctant to buy clothes online or things like that. And if they can't get into clothes are a large portion of retail. Probably more than half of retail is clothes. And you know, it's one thing to buy a T-shirt, but you start buying things that you have to actually fit and try on. It's very hard to break into that market. All right, so Sharp we talked about. Do you expect Apple to go over $130? Yeah, eventually. I think 150 in a couple of years. I mean, you know, look, if they roll out a new product line that starts making money, it's popular, you know, they could make a lot more than that. CEO moved up another chance to short. Oh, yes. No. Oh, where? Oil. Short. Oh, come on, baby. So why is this happening? The dollar's not moving up. I'm willing to go with one here. All right, let's see. I'm so impatient, aren't I? I really should be more patient. Here we go. Okay. Just tell you how to do other stuff. Let's see. Okay, logic. Logic is, I think the Fed is going to not raise rates. That's actually not bullish for the dollar, but they're going to talk about the fact they're going to raise rates. That is a little bit bullish for the dollar. It's unlikely they're going to say anything that's going to be looser than people expect. Not only that, though, but the whole move up in oil is idiotic because there was a huge build. See this? Oh, remember I told that like that orders that you want to look for? See this 205? So that's the guy who's going to stop oil from going much higher. It doesn't look like these guys have enough firepower to get past this guy. So let's just call it over here. Oh, not buy. I want to sell. Now, can we chew up this 54? See how you have 54 here and way less than 54? Whoa! Just as I was saying, that guy pulled his number. Up. Now it's up here. See, that's the thing you got to watch out for, too. These things don't always stay. Oh, wait. Now it's going up so fast I'm thinking somebody must have said something. Whoa! Oh, I just clicked it and it fell. I'm so mad. Oh, there it goes. All right, so where did it come in? At 47. So now I'm in at 53.47. But now that I have it, I now need to go and find out, did anyone say something about oil that we missed? So we'll check out, let's try Seeking Alpha. I doubt they're going to have anything exciting, though. Seeking Alpha. Somebody tell me if there's any kind of news on oil. So that's moving pretty fast. It seems like something happened. ISM, GDP. Oh, they upgraded GDP growth. Bastards. There it is. All news. Citrix, Kia, Princeton. Ugh. Oh, I hate it when they do distributions. Who cares? Says, okay, National Oil, nothing. Volvo sales, 18% down. Nasty. Toyota had horrible sales, too. Honda sales up a bit. Honda's been doing great. Hyundai squeezed out a gain. Subaru with a nice gain. By chemical on weakness? I don't think so. Cooling off on the other stocks. That's interesting. Oh, IMAX. I like IMAX. Oh, here you go. Okay, jump. That is a big jump. GDP now. Where are you guys? That's a huge jump. Atlanta Fed GDP now forecast 3.4%. That's here's where everybody else is. They're up here. I don't see it. I don't see anything from the reports we're getting and stuff that's happening now, unless it's just over some inventory adjustment or something like that. First quarter real personal consumption expenditures and real private fixed investment growth increased from 3.8 and 4.7 to 8 respectively. Construction spending. The construction spending was weak. I'm not buying it. All right. Anyway, all right. So, having not seen anything else really that indicates why oil would be higher, and when did oil start going up? That's the other question. Oh, look, it's working all right. Yep, started going up right about when they raised their forecast. All right. So, having identified the reason that they seem to have raised the price of oil, their forecast, having seen the reason they're probably running oil up and thinking it's bullshit, and having found it, and since we have a very reliable place over here to short, I didn't mind initiating that short at that spot. But it's only one contract, so obviously I'm not too worried about one contract. But the thing is, I then want to find out, why is this happening? You don't just based on where you are on the chart. I want to know why that happened, and then decide whether it's relevant or not relevant. I decide it's irrelevant. Now we got to worry about the Fed and the dollar. And we go, oh, it's 2 o'clock. Damn it, where's the Fed statement? Boy. Rates are unchanged. Let's see what they said. I don't see it. Okay. Labor market continued to strengthen. Economic activity continues to expand. Well, now, they just raised their freaking GDP. He just raised the GDP forecast 50%. Yet, they think it's okay to leave rates unchanged. I want to see how they explain this. Job gain solid. Unemployment near its lows. Household spending rising. Business fixed investment soft. It's exactly the opposite of what the Atlanta Fed is saying in the GDP forecast. Measures of consumer and business sentiment have improved of late. Inflation increased, yes, still below the 2%. That's what they're saying. They're still not seeing enough inflation to make them happy. Measures of inflation compensation, obviously people still aren't getting paid. And nobody expects long-term inflation. The committee seeks blah, blah, blah. Committee maximum employment, price stability. Committee expects a gradual adjustment in the stance of monetary policy. Activity will, with gradual adjustments in stance of monetary policy, economic. So in other words, what they're saying here is that if we raise rates, it won't hurt the economy. Labor market conditions will strengthen further. Inflation will rise to 2%. Near-term risks to the economic outlook are balanced. The committee continues to closely monitor blah, blah, blah. In view of realized and expected labor market condition inflation, the committee decides to maintain the target rate. Wow. There's no logic that goes from here to there. The stance of monetary policy remains accommodative. Yeah, no shit. Thereby supporting some further strengthening the labor market and return to 2%. So basically they're saying, I don't see how you can have the labor market being stronger than it is now. And we see you kick out those immigrants. So they're saying that you've got to hit this number. That's basically their whole excuse for not raising rates. You've got to hit 2% inflation before we're going to raise rates. In determining time and size, the committee will assess blah, blah, blah. And again, 2% inflation. This assessment will take into account a wide range of information, including what measures, shortfall. Committee expects economic conditions will evolve in a manner that will warrant gradual increases in Fed funds. The Fed fund rate is likely to remain below levels in the long run. However, the actual path of Fed fund rates will determine the economic data. And let's see. Wow. Nobody voted against this. Everybody agreed on this one. These guys are getting more and more dovish. Wow, even Fisher? Oh, can't believe it. Makes no sense. I don't like it. This statement doesn't make match with what actually happened. Okay, so let's take a look at what the journal is going to interpret this as. Let's take a look at what the markets are doing. Meanwhile, they're not particularly encouraged by this. So it's a whole lot of nothing going on at the moment. The dollar doesn't know what to do. The dollar ended up coming down a bit because it's weird. Nope, getting a non-reaction from all this. Apple still under 130. Natural gas moving up a bit. Gasoline, yeah. Oh, 53.49. I can add another one. Now, obviously, I had another one. Oh man, I missed it. Damn it. He's still getting a big block at 53.50. Oh, come on. Ah. And it got away. Anyway, so we got the one short. We'll see how it goes. See, this is why it's hard to stare at it all the time. But meanwhile, it's a quick $50 now, $70. You can make $100 in like 10 seconds doing these kind of things. So you don't have to stick with it. If you're happy making $100, that's always a good thing to do. Oh, wait, coming back up. Yes, no. I would like to have two. See how RB's doing for that NG. Or, well, those NGs are up, they're up $1,100. Wow. Kind of good money. Oh, here's RB coming down too. Damn it. Oh well. I wouldn't have done that. I have to see at least 157.5. All right, but if RB is going down, then oil will come down too, so it'll be good. All right, not that exciting. All right, Fed. Yellen's row, revamp Fed. Fed unlikely to make its next move Wednesday. Well, we knew that. Investors hadn't expected the Fed to move. It was a signal about the next meeting. The signal was investors placed roughly 25%, so low probability of a Fed move anyway at the next meeting. Central bank's meeting came in the U.S., blah, blah, blah. Nothing. This guy says nothing. Oh, pointless article. All right. All right, so that's where we are. No, incredibly unexciting outcome from the Fed. It doesn't change any of my minds. We're overbought. People are selling off. And Apple's earnings are hiding the shortfall. Okay. Bill, I was confused about your comments the other day about WBA. Do you think it goes through? What are they selling WBA? It's not a merger. They're Oh no, I'm sorry. That's going to It's the sale to Fred that might not go through. No, the merge is going to go through. They have to divest themselves of a certain amount of assets. Fred is lined up to buy those assets, and it's all getting it's just all screwing around the numbers and the problem is it's like a negotiation, but the negotiation bleeds out into the real world. So instead of just getting it done in a room, they pick a number, and you have to, though, because, all right, here's what happens. The guy from the Justice Department, let's say that Walgreens could be like, we can't allow this to go through. You can't have 8,000 pharmacies. And they go, well, how many can we have? And he's like, okay, you can have 6,000. You can have 6,000. So he goes, okay, you got to sell 2,000. You have to sell 1/4 of your store. So, in order to have a sensible negotiation at that point, Walgreens has to leave the negotiating table, go out into the real world, and says, who wants to buy 2,000 stores? Now, if it's easy to sell them, they'll go back to the Justice Department guy, and they'll say, hey, you know what, we can do that for you. If it's hard to sell them, now, if they can't do it, if it's hard to sell, they have to prove to the Justice Department that that's a ridiculous request. That they can't possibly sell 2,000 stores because they'd have to sell this far below market. It'll cost them this much money, and it's an unfair request. So they have to poke the market in order to do it. They have to find a buyer. They have to see what people are willing to do and so on and so forth. Then they go back to the negotiating table and then say, okay, how about this many stores? How about this many? How about that? How about this? That's what's going on now. It will get worked out. There will be a number that they will settle on. So what about selling WBA puts? I like WBA. I think we own it somewhere. Well, if we own it anywhere, it should be in the long-term portfolio, right? WB. Oh, no, we don't. Oh, isn't that weird? I thought we did. Anyway, I do like them. I guess they never were cheap. That's not so bad. I know what it was. It was more like exactly what I'm thinking right now. I want to know what happens. I want to know what they're actually selling, what the new thing looks like, and I want to see their earnings before I start making bets. Because you don't know what they're going to look like after they do the merge. Oh, here it says amended merger agreement. They dropped, price drop surgery. Oh, 3-part series, jeez. Walgreens will now pay less for each Rite Aid store depending on the number of locations it must divest. It'll pay $7 per share. See how this works? If we have to divest 1,000 stores, we'll pay $7. If we have to divest 1,200 stores, we'll pay $6.50. And there'll be a pro rata divestiture. So that's where they are. It's this weird negotiating thing, and they're saying to Rite Aid, you're worth less to us if we have to divest more stores. We can't afford you. It's a black and white calculation as far as they're concerned. So look what's happened to Rad. Rad's going boom like that. So if you want to bet on them, you would have to gamble that they're going to get more than $6.50 a share or whatever because they're going to have to divest less stores. I wouldn't even want to play that game. And you don't know what they're going to get for the stores they divest. You don't know how it's going to shake up. And, of course, whenever you have a big merger like this, you have acquisition costs, and there'll be a lot of write-offs. So I think on the whole I would probably not do anything until they finalize something. So that's why it's confusing, because it's in chaos. I think it's in flux. You can't really, you can't really be sure about which way you're going on that. TZA March 18 calls. It's not going any for the last 3 weeks. No, I wouldn't imagine they are. If they're ones we hold, it's a hedge. So that's it's not going to go anywhere if the indexes don't fall. So here's TZA, and no, unless the market goes that way, nothing's going to happen. But I'm still thinking the market's going to go down. And frankly, look what happened. It went from 19 to 20 in a day. Then it went from 19 to almost 20 in a day again. So it's capable of some real fast jumps. We're just not getting a sustained move up yet. So they're March. So it's protecting you for 3 months. That's what it is. It's an insurance policy, and the insurance policy expires in March. Then you have to buy more insurance after that one expires. And again, if your longs aren't making more money than you're losing on the short, then you don't need that short. Then you're overhedged. The whole point of portfolio management is not just doing one thing. We have all these positions that we know for a fact are going to make money because we sell a lot of premium. So just if the market stays flat, we know we're going to make money. If the market's down a little, we know we're going to make money. If the market's up, we know we're going to make money. Now, if the market's down a lot, we know we're going to lose money, but that's what we buy the hedge for, just in case the market's down a lot. But you know what? Most of the time it's not down a lot, and we lose the money on the hedge, but we lose less money than we make on the long position. And if you're not doing that, and if you're not well balanced, you need to rethink the entire concept of how you have your portfolio set up, not just the TZA call. That's a small thing. Okay, it's like life insurance, right? You buy life insurance in case you die. You probably won't die. You're buying it in case you die. But you know what? If you have $1 billion, You don't need life insurance, right? What are you insuring? It's like you have $1 billion. When you die, your wife's going to get $1 billion. She doesn't need life insurance. It's a waste of money. All you're doing is betting you're going to die. So depending on how you've got everything else set up, do you or do you not need insurance? Sadie says Trump policies are good for oil. Yeah, of course they are. Rex Tillerson is great for oil. Oh yeah, how's that dollar doing? Let's see how we're doing now. We've got a few minutes under our belt with the Fed. Oh no! What the hell? Did the dollar die? Is that what happened? Can't believe it. They should take the quick money and run. No, the dollar didn't really go down. Okay, I'm going to stick with this. But now we're going to be able to short RB too. Oop. Come back. Everything's going up. Boy, I guess the gist of this is now that the the Fed's going to continue to be easy for longer, and everybody's all happy. Okay, well, we know we want gas at 1575, and we're happy to double down at 1585. So let's see how this comes out. 1574, right there is where we want to be short. Come on, you can make it, baby. Ooh, blasting over. All right, let's sell it. There we go. All right, so I got one short at 1575. I'm going to add over here. That's 53.73. So now my average is 53.60. And I don't know if this is the end. I just wanted to start establishing a position. I would be willing to ride it up to this line and short some more. Because there's nothing in that oil report. And by the way, this has been going on for like 3 weeks now. There's been terrible oil reports. Oil has shot up anyway. And we shorted it, but we've had a rough ride where it's gone up, and then finally it goes back down to like the 52s. So you don't know where the top is going to be, but at least you know it can't stay. Or it's not likely to anyway. Wow, so that was on the nose, the high, where I shorted that barrel. Now this guy's down $220 on 2 contracts. They're down $110 each, 260. So utility-wise, what do I want to do? I would want to raise my average to 53.75. So 15 cents. So it has to be 15 cents over 53.75. So basically at 54 is the next time I want to add. So I can bring my average up to this line. So basically around 54, I'm going to want to add 2 more shorts. Then at this point, I would probably stop out or stop out half and see what happens. But then at 55, I'd be very happy to go back in with more. Because there's nothing in that oil report that suggests that oil should be going up. So right now, this is all about the Fed not doing anything and people speculating about what that means. That's speculation doesn't change the investing sentiment. And people changing their sentiment 5 minutes after some report comes out that did the exact nothing that we thought it would do is all just spin and people pushing you in a different direction. So the herd is stampeding, and right now they're running into things because somebody said, oh, the Fed is now telling you that they're going to stay easy forever. Now, what sounds like a quid pro quo for this? Oh, Saudi said Trump is good boy. Okay. RB spiking, 155 might be a base. A base? No, I don't think so. CL over 53.50. Yep, thanks. And it's $1 down, helpful for the market to go up. Yes, it's very helpful for the market to go up when the dollar goes down, but only in the short term. It's a very short-term effect. I mean, generally, if you look at the long term, the dollar goes lower, the market goes higher, yes. But on a day-to-day thing, it really is an almost immediate intraday repricing that then can be reversed. So I hope that makes sense. All right, now back to the futures. Charts. See, now the actual stock futures, he's not doing good. The only one that's back to where we want to short it is the NASDAQ at 51.50. And they went all the way up to 51.56, 57 before. But I called that at the top this morning, and it was good for a nice 25-point move down. But now we're back at that level. And as you can see, that level is a red line. That's resistance 1. And let's see, nobody else is at resistance 1. They're all by themselves up here. It's not likely they're going to pop over. So let's do that one too. Wait, do I still have these? No, I got out of that. Okay, good. Okay. So NQ is a NASDAQ. And we're right at, oh, what happened? Son of a bitch. Wow, so gas is streaking up. That means oil's going to streak up too. Now remember, I got to be at 90 or better to add, otherwise it's not worth it. Oh, I can't believe that. Right when I wanted to do it, it went down. Futures are very frustrating. So I have 575. So I'm at my goal. I mean, at my exact goal for shorting. I'm not so inclined to jump in and add more here. I'm really excited about adding more here, though. I definitely want to be 4 short up here. So I'll be 4 short at 75 as well. So right here, look how fat these are. The 100, 100, 100, 100 versus hardly any. You see how that works? It pushed up, but it ran into a lot of selling. And then IMAX closes in 6 minutes. So they're trying to push to the high of the day to the close of IMAX. So we'll see where it ends up. And by the way, notice that I didn't get my price, so I'm not playing. As annoying as that is, I wanted to get 50. I didn't get 50. I'm not playing. Because you're talking about a lot of money here. If I come in at 48 and it goes up to 50 where I want it to be, then I'm going to lose. I'm going to lose I forget what the NASDAQ is now. NASDAQ $20 a point. I think NASDAQ's $20 a point. So I'm going to lose $40. I don't want to lose $40 for no reason. I'm not giving that up. That's you can't give away a $40 cushion every time you make a bet. You either get your price or you don't play. Because if you make 10 bets a day and you give up $40 10 times, you're down $400 before you even do anything. You can't do that. You have to have a discipline that does not give up money. You don't leave it on the table, and you don't give it up when you take it when you're making a bet. It's like if you want to bet on football and you always take whatever odds somebody gives you, and you don't shop around for the odds. That's crazy. You can't just get odds. You have to get good odds. That's why people watch the odds and check these things in sports. Because you can't go around taking worse odds bets than other people are taking. You'll lose more. You will lose money. So it's guaranteed. You have to get good prices in everything you buy, or you're just throwing money down the tubes. So like here, I didn't get my 90, so I'm stuck with just 2 contracts. Okay, I can live with that. And I'm not getting it high here, so I'm not doing anything here. And he's at 49 now. Might hit my price. Here's my goal, 50. I'll even put it in there. My order's in. So come on, if they dare. 49.50. Of course, I'm never going to be satisfied with one NASDAQ short. It doesn't pay enough money. But come on. Ow. So disappointing. So that's what I'm willing to short at. They won't give it to me. And I don't want it badly enough because I already have the short on oil. I have the short on oil. I have the short on gasoline. I'm not dying to have the NASDAQ short. So I'm not going to chase it. I'm not going to work into it. Oh, well. All right. Oh, wait. See, as soon as I take mine off. Isn't that interesting? I think I might be the only real bet on here. As soon as I took it off, it started moving back up. Weird. All right. Anywho, Facebook and Amazon are also announcing their potential to move the NASDAQ. Should we wait until after out? I don't see how Amazon can possibly do anything that's going to justify the price they're at. 200 times earnings. If their earnings are growing at 100%, they're at 100 times earnings. Okay, that's a bit much. Now, Facebook is a good, solid company, but they're priced like a normal company. Amazon is just priced ridiculously. I'm not saying it can't go up, so I'm not going to really make a bet heavily against them or for them. I'm just saying, but I understand the NASDAQ obviously is a bet against them. So yeah, I wouldn't make a huge bet, but I do think that we're going to correct back down. I think these tech earnings are as much as you're going to get. See, even Facebook is trading at 60 times earnings. It is not that realistic. They don't, look, they, I mean, this is good. They went from 228 to $4. Now they're going from 4 to 5. So their growth, though, it was 100%. Now it's 20%. But they're still being priced like they're growing closer to 100%. I mean, these are spectacular numbers. They're a great company. They're monetizing fantastically. That's 712, that's 50%, but then that's slowing a little bit. And then since then, 17. And here we have, look, see, now where's the growth? 13, 18, 22. So the growth is slowing down. They're normalizing. And there's nothing wrong with that. There's nothing wrong with a nice, normal 20% growing company. But you don't pay 60 times earnings for a 20% growing company. Eventually, this will bite you in the ass. Not tomorrow, but eventually you will end up. They'll report something dead, something will happen, and it'll drop tremendously. And you go, oh my God, I can't believe that happened. I mean, basically, we just don't play these things. We stay away because people are so stupid. They jump up for no reason. We played Facebook once when they were down, but they haven't been down for a long time. And I don't mean down here. I mean they were significantly down a couple of years ago. Back here when they were down like here, we liked them. But this is double. They shouldn't be double. They were a good deal here because they were only like 35, 40 times earnings here, and they were certainly growing very fast. Now they're not growing as fast. They've got the same multiple. Doesn't make sense. And Amazon, forget about it. I mean, again, like I said, if it wasn't for the cloud, and my thing about the cloud, and again, it doesn't mean Amazon can't go to 1,000 first, but cloud services are a commodity. They're in a very high growth phase because everybody is moving to the cloud, and there's more and more and more data all the time. So it seems like there's a lot of growth, and it seems like it's going really fast. Just like at one time, the hard drive business was growing incredibly fast. The memory storage business was growing incredibly fast because there is a lot of memory, there is a lot of drive space. So what happens? After the initial growth cycle, it starts becoming a commodity to the point where you can now buy a 3 terabyte hard drive for $100 in Staples. It's like a thing. I think I told you guys before, like the first, when I worked in computers, I sold my first big sale was a 300 megabyte hard drive that I sold to a doctor as a server for his office, and had to be special ordered, a 300 megabyte hard drive, and it was $25,000. Now you can buy a 3 terabyte hard drive, which is, 1,000 times bigger for $100. And I'm talking not even 30 years ago, the thing was $25,000 for 300. That's what's going to happen to the cloud. At the time, I mean, and yes, now I've got 3 terabytes of use on my TiVo. Okay, so yes, of course, your use of storage expands, but the reality is you can't sell enough 3 terabyte drives to feed me as a computer salesperson. That's why I left computing, because I saw it was happening. It was commoditizing. There was no money left in it for the salespeople. It used to be, at the time, that $25,000 drive, I think must have been probably 50% profit on it for $17,000, and I got like a 20-something% commission. So I made like $3,000-$4,000 for selling the drive. That was a good business back then, right? So that was fun. I had a couple of good years selling computers, and it was great. But you could see the prices coming down and the margins coming down and so on and so forth. It takes years, but it happened. And now a guy in Best Buy, a salesperson in Best Buy is like a minimum wage job, or barely above minimum wage, because it's a freaking commodity. They can't afford to pay you a big commission for doing it. They pay you the commissions on the service contract. That's profit. But the hardware, no, there's no money in hardware. And it's not different in the cloud, okay? It's just the new thing. But soon cloud storage space will be a commodity, and it will sell for pennies on the terabyte, and it won't be profitable. And it doesn't matter how big of a market share you have in something that doesn't make money. But that's, again, it's a long view. But the problem with Amazon is they lose money. They've got, unlike other cloud companies, they've got this gigantic money-sucking part of their company, the retail division. And it's being supported by the cloud division. If the cloud division's profits start going down, the whole company will start showing losses, and they will not be able to fix it. It will get worse and worse and worse, and the worst thing they can do is to sell more stuff, because they lose money every time they make a sale. It looks good now because they're growing in a $3 trillion retail space. They've taken $100 billion worth of sales. That looks like growth. And the mantra with Amazon is everybody says, oh, if he feels like it, he can make money. No, that's not true. Bezos has made an expand or die business. They have to keep growing. They have to keep taking market share. They have to keep bringing in new lines, because if they stop, everybody will realize they're not profitable. He needs the excuse of the growth to look like he could make a profit. But the reality is it's only the excess cloud space that comes from running the retail operation that becomes profitable to sell. Once everybody's got excess space, it'll no longer be profitable to sell. IBM is coming out with a 3D bubble memory chip that's going to have 1,000 times more storage than current memory chips. That's going to be the death of cloud companies. Because right now, what a cloud company has is they've got giant server farms in giant buildings that require special cooling and this and that and special power and so on and so forth. Once you don't need that stuff, then the whole thing gets decentralized, smaller companies step in, and all their investments get flushed down the toilet. And it's not going to happen next year, it's not going to happen in 2 years, but 3 years, 5 years, I wouldn't want to bet on it not happening. So, is it early not to like it? Not for me. Why would I want to tie my money up in Amazon now when at any time a breakthrough can really start hurting them, or people start saying, all it takes is for other people to start saying, hey, this business has no future. In fact, and another big threat is Walmart. Walmart just spent $3 billion buying an online company so that they can better compete with Amazon. They haven't done it yet. They only did it 6 months ago. It takes a year or so to put all that stuff in place, but Walmart's going to roll out a massive competitor to Amazon. And Walmart are the guys who have $500 billion in sales and make money selling it. Amazon doesn't make money on the retail side. Walmart knows how to actually make money selling stuff. And they've got a store footprint, which means everything you buy from Walmart, you can return to your local Walmart store and get your credit or your money back or whatever. It means that they can have a person deliver something that's big or heavy, and they can send out people to help you. They can do everything Amazon can do, and then they can do a whole bunch of more stuff. And they're 5 times bigger than Amazon to start with. They just haven't made the push into online. And why hasn't Walmart made a push into online? Because there's no money in it. Why would they do that? Why would they want to do something that makes no money when they make money? Again, this is why Amazon doesn't have competition. You're not going to have competition losing billions of dollars. It's not something everybody wants to do. Amazon has lost staggering amounts of money in its history. It has never really made money until like last year, and the cloud business is starting to make them money. But this is a blip in their history. The money-making part is the blip, not the losing part. That was going on for 20 straight years. Oh, wait. I always forget to check on my stuff. Oh, look at that. Okay. Nothing there, nothing there. Okay. Oh, you're kidding. Oh, you hit right in my spot, and I wasn't watching. Damn it. See? Now, what I would have done is if I sold 2 more, my average would have been 75, and now I'd be out, and my average would be 75, and I'd be in the green. That's how you play it if you're paying attention. I wasn't paying attention. Still, I'm very confident in the trade, so I'm not too worried. Oh, and he hit 51.50. Oh. Guys. No fun if I'm not making money. Come on. All right. Too busy talking. Oh, you guys did tell me. See, I'm not reading while I'm talking. Right? I'm trying to. It's not possible for me to do this properly and trade properly. That's the problem. Last webinar you started out. That's why, by the way, that's why the full day session when we do it in Vegas is great because we're focused 100% on the trading, on trading setups, on finding stuff. You know, it's not like this where it's got this back and forth that I have to do. That's going to be, yeah, if you guys are interested, there's a sign up. If you follow today's post, you can sign up for the 2-day seminar in Las Vegas. On the last webinar, you started analyzing, and we got 2 giant screens and things. It's a lot easier to do stuff. On the last webinar, you started analyzing, and I'm answering questions by people who are in the audience talking, not, reading them. On the last webinar, you started analyzing the 85 stocks Goldman Sachs put up on the buy list. Oh, yes. I cannot continue. I'm still actually running some of those things through different things. It will be something we go over at the Vegas seminar, though. And when I come back from Vegas, I put a list up. We're not doing a seminar next week, by the way, because I'm leaving for Vegas on Wednesday. So no seminar next week. We are doing the Vegas show a week from Sunday and a week from Monday. Those are the 2 days of the Vegas thing, the 12th and 13th, I believe, of February. So it's Sunday and Monday at Caesar's Palace. Maybe we should be showing the dollar. I wouldn't. It's such a random thing, and if anybody says something, it sends it flying one way or another. It's not the kind of thing. Will you still be in touch with the homebody? On Monday, yes, but we always, yes, but not much. We'll certainly every once in a while look at questions from the chat room, but in reality, look, it's a Monday session. My job, what I'm doing there is we're talking about trading live there, so it'll be kind of like a day I'm not there, but I will check in once in a while to say hello. My mouse is blinking at me. Oh, I was doing that last week too, wasn't I? I don't use this computer much, that's why. So it only gets upset when I start using it. All right, so basically it's exactly what we thought. Though the reaction to the Fed was a stupid reaction, and everything went up, and now it's coming back down. It's not complicated. I like it when things do what they're supposed to do. It's a lot better. All right, let's see what kind of news we've got. If anybody said anything important. Porsche is up 6%. BMW down. Air Methods, who the hell are they? WePro, Tesla, and 20 others test autonomous cars in California. 20 others, wow. Speaking of people who have no actual competitive advantage, Chevy beat them to the punch with a cheap car. There's 20 other people with autonomous cars. What is it exactly Tesla does? What do they do that's unique that makes them worth 200 times earnings? Nothing. Not 200. They don't have any earnings. Whatever insane price they're at. They're like another ridiculous stuff. Fed stays on hold. As expected, the Fed left policy unchanged with the Fed rates remaining 0.5 to 7.5. The vote was unanimous. Wording in the policy statement was in line with the Fed December meeting, moderate. It's really all about the Atlanta GDP thing, but the Fed statement contradicts the Atlanta GDP. I don't know what the hell they're doing there. Xanax. This is back to where we were, right? So nothing's happened. Nothing, no news. All right, last question then. We're going to call it a day. We seem to be in good shape. Will the seminar be recorded? This one, no. The Vegas, no. The problem is to have the thing recorded properly and do it with I have to get mic'd, and we have to have a camera guy, and blah, blah, blah. It was like $1,500, $2,000 to have the whole thing done with the production that we need and to get everything done right. And you're talking about, 6 hours. So you have to then put it on you can't really stream it. It's like a DVD thing you'd have to do and put it out. So unless you actually had enough people who wanted to pay for it, it's just not worth doing. So no, the reality is come to Vegas and we do it live, and otherwise we do the tidbits here. But it hasn't been worth recording. In fact, we even asked one year if people wanted to pay for it, and not enough people volunteered, and so I lost interest. I'm like, I don't care. It's not worth the effort. That's basically the cost of that $2,000 to record the thing. That's when we looked into it. So everything looks good here. We're leaving it off then. We're leaving it off where all we have right now, because we missed the NASDAQ shorts. Oh, look at 10 points already. Is we have the oil is short at 53.60. We're not even at 53.60, so that's still doable. We're short here at 157.50, and that's basically even right now. And we haven't got any index shorts. And my favorite is still the NASDAQ at the moment, because I think that's going to have a pullback. But we'll see what happens tonight with Amazon. This was our best short of the day. Was 1375. We got a nice run on that. Nobody else is near a place I would want to short them. So if Amazon or Facebook have really good earnings and the NASDAQ pops again, I'll be interested in reshorting the NASDAQ. Oil, I got conviction on this. I'll ride it out. Don't forget, the closer we get to the 20th, when the contracts roll over, the better chances are of the pressure mounting on the market. So unless there's some definitive statement, look at the dollar. Oh wow, the dollar went down to 99.50. That's what spiked oil up. So the dollar went down to 99.50. That shot these guys back up. Oh yeah, and we're long on natural gas still. Forgot about that. Got the natural gas at 3.15. I'm still long. So that's a half point. Now, the fact that these guys are dropping anyway, with a half point down on the dollar, that means these indexes are exceptionally weak. So I think you can expect some pretty steep drops. Now, on the contrary, if anything bad happens with Amazon or Facebook, you can expect a really big knockdown in prices overnight. So that's the prediction I'm going to leave it at. I still like shorting. If I was going to short something, I'd short the NASDAQ at 51.40. But we already have our TZAs and our SQQs and blah, blah, blah. I don't need to chase every single future play there is. It's not worth it. Is it smart to short RB into the weekend? It's not smart, but it's fun. Generally, RB likes to run up into the weekend, but then after the weekend, it usually comes back down. So I like the technical short here. I think the inventories, obviously the inventory build was ridiculous, so I think the weakness is here. And what we have been doing is basically we've been shorting these spikes after inventories, and then sometime like Friday we've been cashing out, but then it usually comes back up into the close on Friday. I haven't had to hold it long over the weekend yet because we've always gotten a good move down by Friday. But then once you get that good move down, you could go long, theoretically, into the Friday close because that almost always gets a bit of a pump. But there is nothing in that energy report. This is now 3 straight weeks of build. Nothing in that energy report that suggests that you should be long on oil. And the fact that a Saudi guy says Trump is good for oil, that really doesn't mean you should be. That doesn't do anything either. That's just talk. All right, so it's going to be a couple of weeks before we do our next webinar. It won't be this week, but it will be when I come back from Vegas. So we'll definitely be talking about the stuff we did talk about in Vegas on the Wednesday after the thing, which is 15th? I'm guessing. The 15th. Wow. Boy, I know my days. All right, so the next webinar, we're not doing one next week because I'm flying next week, and we will do it on the 15th. That'll be our next one. The live Vegas is the 12th and 13th, and I leave Vegas on the 14th. That's how it works. All right, guys, thanks very much, and we'll do it again. Have fun.